let's talk about one of the most misunderstood borrower profiles in mortgage lending, the thin file borrower, because I see this mistake happen all the time. A professional pulls credit, the score isn't where they expected. The file is limited, there aren't many trade lines. And almost immediately the borrower gets mentally placed into the wrong category: risky, unqualified, credit challenged. But here's the problem. A thin credit file and bad credit are not the same thing, and understanding the difference matters. Let's start with bad credit. Bad credit usually means we have information that indicates elevated risk. Late payments, collections, charge-offs, high utilization. Patterns that suggest financial distress or inconsistent credit management. That's information. That's visibility. Now let's look at a thin credit file. A thin file doesn't necessarily tell us that someone is risky. In many cases, it tells us we don't have enough information. That's a completely different conversation. Think about a recent college graduate, a young professional, a renter who has never needed a credit card, a consumer who intentionally avoids debt. These individuals may have limited traditional credit history, but limited visibility isn't the same thing as elevated risk. And that's where confusion begins, because credit reporting doesn't just help identify risk, it helps create visibility. The challenge with thin files is often a lack of visibility, not necessarily a lack of responsibility. And I think this is becoming an increasingly important conversation in today's lending environment. Because consumer behavior is changing, many younger borrowers use credit differently than previous generations. Some avoid revolving debt, some rely on debit cards, some simply haven't had enough time to establish lengthy credit histories. Yet they may consistently pay rent on time, manage household expenses responsibly, and demonstrate strong financial habits. The question isn't always, are they risky? The question may be, can we see enough information to properly evaluate them? That's a very different discussion, and it's one reason conversations around alternative data continue to grow throughout the industry. Because the goal isn't lowering standards, the goal is understanding borrowers more completely. At My Credit Info, we spend a lot of time helping professionals interpret what they're seeing inside a report. And sometimes the most important thing a report tells you is what it doesn't tell you. Because no credit and bad credit are not the same thing. Visibility and risk are not the same thing. And understanding that distinction can completely change the conversation. If you found this valuable, follow My Credit Info for more mortgage credit insights. And share this with a loan officer or real estate professional who works with credit every day. Because if you pull credit, you should understand it.